In a remarkable transformation of global energy dynamics, China's imports of U.S. crude oil have plummeted by almost 50%. This decline not only reflects China's shifting energy priorities, but also signals a significant reconfiguration of the global oil market. According to new data from Compare, China acquired only 81.9 million barrels of American crude in 2024, a steep drop from 115.6 million barrels the previous year, marking a staggering 46% decrease. As a result, China has fallen from being the second largest buyer of U.S. oil to the sixth position. Below, we explore the key factors contributing to this dramatic decline and its implications for the global oil landscape. The shift in China's import strategy. China, long acknowledged as the world's largest oil importer and the second largest consumer, has historically sourced crude oil from a diverse range of suppliers to meet its immense energy demands. However, recent studies reveal that China's overall crude imports have decreased by approximately 7.2% compared to the previous year. This decline can be attributed to sporadic COVID-19 lockdowns, limited local reserves, and anticipated upgrades to refineries. In response to this situation, China has strategically adjusted its purchasing approach to secure more favorable and flexible terms. Customs data indicates a deliberate shift away from certain Western suppliers, highlighting Beijing's multifaceted strategy to obtain cheaper oil and enhance energy security. The rise of discounted crude supplies. Recent metrics from Kepler indicate that the proportion of seaborne crude imported by China from Russia, Iran, and Venezuela has increased from 24% to approximately 26%. While this 2-point rise may appear minor, it represents a significant real gain considering China's enormous import levels, often exceeding 10 million barrels per day. Russia has been offering substantial discounts on its Urals-grade crude due to Western sanctions, making it an attractive option for Chinese refiners looking to lower their feedstock costs. Similarly, Iran, despite facing U.S. embargoes, continues to supply crude to China using discrete methods such as disabling transponders or conducting ship-to-ship transfers in locations like Malaysia or the Gulf. Venezuela, heavily impacted by American sanctions, still manages to export through complex payment systems and intermediaries, with its low prices appealing to smaller Chinese refineries. Collectively, these more affordable sources have compensated for the decline in Western supplies and strengthened China's ties with these diplomatically isolated nations. The shift towards sanctioned or discounted exporters is driven by a combination of financial and geopolitical considerations. On the financial side, Chinese refiners benefit from robust margins by acquiring crude at prices significantly lower than global averages, allowing them to either reduce domestic fuel prices or increase refined product exports, particularly within Asia. Additionally, diversifying suppliers enhances China's energy security by minimizing dependence on any single source, thus lowering the risk of political disruptions. Another key factor is the potential for expanding diplomatic and trade relationships with countries like Russia, Iran, and Venezuela, which are eager to find new markets to bypass Western sanctions. This approach solidifies China's position as a significant player willing to operate beyond the influence of Washington. Tracking and trade dynamics. The movement of banned vessels to China is often intricate, as analysts from Caparvexa and other firms utilize satellite imagery, AIS signals, and port logs to monitor ship activities. These records uncover tactics such as disabling AIS and executing mid-ocean transfers, often near Malaysia, to conceal true origins. Chinese customs statistics may overlook barrels from Iran or Venezuela, as some shipments are misclassified as coming from Malaysia or Oman. Nevertheless, the noticeable increase in deliveries indicates a strategic effort to exploit pricing discrepancies. While a 2-point shift in import breakdowns may seem minor, it translates into billions of dollars due to China's immense demand, significantly altering maritime shipping routes. This shift also exerts pressure on established suppliers like Saudi Arabia, Angola, and Brazil, prompting them to occasionally revise their official pricing to maintain market presence. Wider consequences for global oil markets. China's shifting purchasing habits significantly impact global energy dynamics. The influx of heavily discounted oil from sanctioned sources raises questions about the effectiveness of Western sanctions and reveals alternative channels that keep oil flowing by favoring lower-priced barrels. This behavior allows China to sway global price benchmarks and shape market sentiment, particularly if it continues with its current strategies. China's aggressive procurement tactics lead to competitive pricing shifts, prompting changes in supply routes and contract terms. The situation is especially precarious for Russia, a crucial member of OPEC+, as its discounted oil exports to China could undermine collective efforts to maintain elevated prices in the long run. Strengthening ties between China and marginalized oil-producing nations may alter global alliances, highlighting Beijing's role as a key oil buyer, willing to operate beyond the influence of the US-led system. These actions not only secure more affordable energy for China, but also enhance Beijing's position on the global stage, potentially setting the stage for significant shifts in energy markets and international relations. Rise of electric vehicles and renewables. China is rapidly increasing its adoption of electric vehicles, a shift that will significantly impact oil consumption. As more Chinese drivers choose EVs and the government promotes electrification in both transportation and industry, the demand for oil is likely to decrease in the future. Furthermore, the growing use of cleaner energy sources such as LNG will further reduce reliance on petroleum-based fuels. China and BRICS countries. China's strategic financial shift alongside BRICS nations, which are pivotal global oil suppliers, has profoundly transformed international energy dynamics, especially as Western powers enforce sanctions in response to rising geopolitical tensions. China and Saudi Arabia. The energy relationship between China and Saudi Arabia has significantly expanded recently, moving beyond just crude oil to encompass renewable energy and technological partnerships. In 2023, Saudi Arabia continued to be a cornerstone of China's oil imports, with trade between the two nations reaching approximately $17.7 billion, primarily driven by oil exports. However, both countries are now focusing on clean energy initiatives. Saudi Arabia's Vision 2030 aims for 50% of its energy to come from renewable sources by 2030, and Chinese companies are playing a crucial role in this transformation. For example, in August 2024, China Energy Engineering secured a $972 million contract to build a 2-gigawatt solar farm in Saudi Arabia, collaborating with local partners such as the Public Investment Fund and ACWA Power. Additionally, in July 2024, Sunro Power Supply of China joined forces with Saudi-based Alias Holding to develop an energy storage facility with a potential capacity of 7.8 gigawatt hours, enhancing the stability of the kingdom's power grid. Their financial collaboration is also on the rise. In November 2024, China selected Saudi Arabia for its first dollar-denominated sovereign bond issuance in 3 years, with plans to raise up to $2 billion in Riyadh. This strategic move not only highlights China's support for Saudi Arabia's Vision 2030, but also emphasizes the deepening economic ties between the two nations. China and Russia's energy relation. Following Russia's annexation of Crimea in 2014, Western nations imposed sanctions targeting key sectors of the Russian economy, including energy, defense, and finance. In response, Russia initiated a strategic pivot towards the east, seeking to strengthen ties with Asia-Pacific countries, particularly China. This shift gained significant traction after the onset of the Russia-Ukraine conflict, which prompted even stricter Western sanctions aimed at isolating Russia. As a result, Russia began exporting discounted oil to China, and by 2023, trade between the two nations exceeded $240 billion, with energy exports being a crucial component. In 2024, China completed the Power of Siberia pipeline, enhancing its access to Russian gas, which aligns with its broader strategy to diversify energy sources and secure long-term supply. Additionally, Russia has explored increasing gas deliveries to China through the upcoming Power of Siberia 2 pipeline, redirecting flows that were originally planned for Europe. If you're enjoying this video, please consider hitting the like button to help us reach a wider audience, and feel free to share your thoughts in the comments. Your feedback is invaluable. Thank you for watching, and let's continue. China, Iran energy relations. China's oil trade with Iran has been significantly influenced by international sanctions. Yet despite Washington's efforts to curb Iranian oil exports, China continues to purchase oil from Iran, often at discounted rates. These transactions not only ensure a steady supply of affordable energy for China, but also provide Iran with essential revenue. In October 2024, the United States imposed new sanctions targeting Iran's oil and petrochemical industries, aiming to reduce Tehran's financial resources for missile development and other related activities. China-UAE trade, the energy trade between China and the United Arab Emirates, UAE, has experienced remarkable growth recently, establishing a robust alliance in this sector. In 2022, the United Arab Emirates exported approximately $17.4 billion worth of crude oil to China, which constituted a significant portion of their bilateral trade. During the same period, the UAE's natural gas exports to China amounted to around $412 billion, further emphasizing the centrality of this partnership in the energy domain. By 2023, total trade between the two nations reached approximately $95 billion, with non-oil trade accounting for $83 billion, reflecting a 7.5% increase compared to 2022. Both countries aspired to achieve a trade volume of $200 billion by 2030, indicating a mutual commitment to strengthening business relations. Strategic joint ventures have been instrumental in this growth, particularly under the Belt and Road Initiative. In July 2024, the China National Petroleum Corporation, CNPC, established closer ties with the Abu Dhabi National Oil Company, ADNOC. Additionally, the China National Offshore Oil Corporation, CNOOC, signed a strategic agreement with ADNOC to collaborate on exploration, production, and trading of crude oil and liquefied natural gas, LNG. These agreements highlight the desire of both nations to enhance their energy trade. Moreover, both countries have placed a strong emphasis on renewable energy. They have committed to promoting green investments, underscoring a shared dedication to sustainable energy practices and environmentally friendly initiatives. China's leadership in solar technology has resulted in a significant increase in shipments of solar modules to the Middle East, including the UAE, thereby supporting local clean energy objectives. The economic significance of this partnership is another crucial element, as China has consistently been the UAE's largest trading partner, while the UAE ranks as China's top export destination and second largest commercial partner in the Middle East. Bilateral investments have also seen substantial growth, with Chinese investments in the UAE rising by over 16% in the past year to reach $1.3 billion. Conversely, UAE investments in China surged by 120%, accounting for 90% of all Arab capital flows into China. Implications for East China energy trade. China's alliances with Russia and Iran extend far beyond oil, encompassing broader diplomatic and trade aspirations. By strengthening ties with these nations, China aims to diminish Western influence and enhance its own self-sufficiency. This strategy is closely aligned with the Belt and Road Initiative, which seeks to expand China's global presence through infrastructure and commercial ventures. Geopolitical and economic considerations. China's alliances with Russia and Iran extend far beyond oil, encompassing broader diplomatic and trade aspirations. By strengthening ties with these nations, China aims to diminish Western influence and enhance its own self-sufficiency. This strategy is closely aligned with the Belt and Road Initiative, which seeks to expand China's global presence through infrastructure and commercial ventures' impact on U.S. economy. A decline in demand from China could result in an oversupply of crude oil in the United States, which may lead to a decrease in domestic prices. This situation could negatively impact revenues for American producers and hinder growth and job creation in the sector. Furthermore, if China's reduction in imports continues, the trade deficit in the U.S. could widen, influencing various economic indicators. Additionally, rising geopolitical tensions and ongoing policy disagreements are reshaping these trade dynamics. The protracted tariff conflict between the US and China, characterized by tariffs and trade barriers, has prompted China to seek alternatives, reducing its dependence on American crude. This transition underscores the intricate relationship between international politics and economic trends. China's oil import trends China's journey in the global oil market highlights its remarkable economic transformation and growing influence over the past 4 decades. Once a net oil exporter in the early 1980s, China has now emerged as the world's leading crude importer. This shift was driven by rapid industrialization, changing energy strategies, and strategic international partnerships. A pivotal change occurred in the early 1990s when China transitioned from being a net exporter to a net importer in 1993, spurred by significant economic reforms and a manufacturing boom that increased domestic consumption. Local production, such as that from Daqing, struggled to keep pace with demand, leading to a reliance on foreign oil, initially sourced from Southeast Asia. As China joined the World Trade Organization in 2001, its demand for oil surged, fueled by a massive economic expansion linked to manufacturing and infrastructure development. By the end of the decade, imports had consistently risen, surpassing 4 million barrels per day. The 2010s marked a new era, with imports reaching unprecedented levels. By 2017, China had overtaken the United States as the top crude importer, driven by robust industrial output and a burgeoning consumer market. The diversification of suppliers accelerated, with China reducing its dependence on the Middle East and increasing imports from Russia and select African nations. By the end of the decade, imports were around 10 million barrels per day, solidifying China's position in the global energy landscape. Despite the disruptions caused by the COVID-19 pandemic, China's oil imports remained resilient, averaging nearly 11 million barrels per day, partly due to strategic stockpiling during price declines. In the following years, while the market experienced volatility, imports peaked at 11.3 million barrels per day in 2023, reflecting a vigorous economic recovery and underscoring China's significant role in the global oil arena. China's strategic move to cut or halt oil imports from the US, while strengthening ties with BRICS partners, particularly Russia and Iran, signals a significant shift in its energy and global strategy. This approach highlights China's commitment to securing its supply chains, managing costs, and aligning with allies that share its vision under the BRICS framework. However, this pivot comes with substantial repercussions for the US, impacting both its economic interests and global standing. China's reduced reliance on US crude oil coincides with BRICS' ambition to foster a more multipolar world. The Western sanctions on Russia due to the Ukraine conflict have provided China with an opportunity to acquire cheaper Russian oil, further solidifying its shift. Additionally, increasing imports from Iran diversify China's energy sources, making it less vulnerable to American trade pressures and disputes. By engaging with these suppliers, China not only secures more affordable crude, but also opens the door for transactions that bypass the dollar, challenging the petrodollar system that underpins U.S. financial dominance. The decline in U.S. crude purchases by China could disrupt the domestic oil market, as China has historically been a major consumer of American oil. This reduction may lead to oversupply and price declines in the U.S., potentially squeezing profits for American producers, curtailing investments, and resulting in job losses, with ripple effects felt in shipping and refining sectors. On the diplomatic front, this shift diminishes American influence in global oil markets. China's strengthened relationships with other BRICS nations aim to establish an alternative economic hub that directly challenges US-centric frameworks. The BRICS initiative to create parallel financial systems and reduce dependence on the dollar may gain momentum from this retreat from US crude, further eroding a key lever of American power. Moreover, decreased Chinese purchases could widen the U.S. trade deficit, as petroleum exports represent a significant significant portion of US-China trade, intensifying tensions between the two nations and complicating efforts to mitigate the economic fallout. Thank you for tuning in to this video. We truly appreciate your presence today. If you found our content meaningful or inspiring, we would be grateful if you could show your support by liking this video and subscribing to our channel. Your engagement is incredibly important to us. Don't forget to check out another video from our channel that's currently displayed on your screen.